what was the logic of the $500 million sovereign bond payment in January when currently we have less than $20 million in the coffers?
Yeah, so I think there was a lot of um, since 2020, and the pandemic broke out, Chamber and so many others, want the government to go to the IMF, seek some level of assistance at that point. Find out what you're seeing, what Bangladesh have done when they lost a little bit of reserves, and there's a slight downturn. They've, quickly looked at the different measures and acted upon it. Unfortunately, we didn't. I think our strategy was more homegrown strategy, which really relied on exports doing exponentially well, FDI coming in, things like Port City really coming in a big way. And I think our expectation was that India or China will, continue to bail us out, which did not materialize. We could have avoided, paying. We could have, similar to what Ecuador did before the pandemic. They went out to the market and said, "Hey, we can't afford to pay this. We need to take a pause, and we will come back to you with a plan." And that's how they kind of restructured their debt within 5 months, and now they've come back into the market as well. But we lost that opportunity very early on by delaying going to the IMF and pausing our debt, and eventually we only stopped paying the debt in April when reserves were at what it is right now. So that 500 million, unfortunately, could have been kept back, could have been used in hindsight for payment of essential imports. And
Diaries series, where we will be talking to an expert and we will be sharing experiences in different fields of studies. So as Asia Pacific Institute of Information Technology, we are honored today as well to be hosting this session together with another veteran in the global corporate world, especially in a time where we are talking about national as well as international challenges in terms of commerce, business, and other fields as well. So let me warmly welcome all the students who are joining us from Staffordshire University in our postgraduate and undergraduate programs. And of course, all the other members who are in this platform today, especially joining us from all around the world, our delegates, foreign delegates, and diplomats who are joining us as time permits, and our counterpart university members from Staffordshire University, from Deakin University, as well as from AIT Thailand. And together with that, let me also warmly welcome all the other corporate guests and distinguished guests who are in the platform as well. So to start off with, I would like to introduce Dr. Rohan Thatukorala, who is one of our directors at APIT Sri Lanka, and most importantly, the pioneering personality behind bringing these networking opportunities to all our students and all our viewers. He will introduce our speaker for the day today, and he will continue the session from now onwards. Dr. Rohantha, over to you.
Thank you very much, Kaushali. And actually, I'm honored to introduce this personality whom I have a lot of respect for. He happens to be the chief economist at the Ceylon Chamber of Commerce and leads the Economic Intelligence Unit, which is the focal point of the Chamber of Economic Research and Policy Advocacy. He was previously member of the steering committee of the economic policy of the Ceylon Chamber of Commerce, and also he held the role of the lead economist and senior product head at Frontier Research. He has been part of numerous economic and business forums, both locally and internationally, as a speaker, panelist, and a moderator. He's contributed as a writer to one of the premier magazines in Sri Lanka called LMD, the Monthly Economics Outlook, and also an alumnus of the US International Visitor Leadership Program, IVLP. He holds a Bachelor of Economics and Finance from the University of London, an ACMA and CGMA professional qualification, a postgraduate diploma in international relations from the Bandaranaike Center for International Studies, and an executive MBA from the Postgraduate Institute of Management, Sri Lanka. Ladies and gentlemen, it's actually an honor for me to introduce the Chief Economist of the Sigon Chamber of Commerce, Mr. Shiran Fernando.
Thanks, Dr. Rwanta. Thank you so much for this opportunity, and thank you, Rapid, for inviting me. I know it's I often joke that it's the best time or the worst time to be an economist in Sri Lanka, but it's always interesting, in particular when it's difficult to predict, even how the next day is going to pan out. But we will go through some of the key developments, put a few things in perspective, and then maybe after a 20 to 25-minute presentation, we'll get into a quick Q&A, if that's okay with everyone. I would focus the kind of remarks in three aspects. Basically, we'll go through some macro themes, which will be a large portion of the presentation, and then it'll be really what is our way out. What are some of the things that we should be looking at? Since most of you are working in corporates as well, I think it's key. Some of you may be involved in planning, in marketing, and different spheres as well, but it's always good to know some of the indicators that we should be looking at, and what are some of the implications from a planning perspective as well. But before we get into the local economy, I think while everyone is kind of, the energy and the noise is around the local economy, I think one thing we can't forget is really what's happening on the global economy side. What we did see with the pandemic in 2019, 2020 was we did see a downturn, which was very short. We saw the recovery in 2021. But what we also saw within that period was a quick boost being provided to the economy and to the global economy. A lot of central banks reducing interest rates, a lot of finance ministries across the world providing more money to businesses to recover, to people as well. There were a lot of cash transfers provided, and that really stimulated growth, and people started, having more disposable income. People started ordering things more, and that had a bit of impact on the supply chain. And we did see shipping rates, freight rates all going up because the supply side couldn't handle the demand side, which was ordering in particular from the West. And then we've now seen, because of that, things like oil prices, commodity prices, even food prices, all escalating much higher. And with the conflict in Russia and Ukraine, we've seen that also having an impact on economic activity, slowdown in Europe in particular, which relies a lot on Russian oil and natural gas coming in, and an overall slowdown in the US market. So within a 3 to 4 year period, we've really seen an up and down situation in global growth, from it being seemingly going up pre-pandemic, then a downturn in 2020, then an upturn in 2021, and now once again a downturn predicted in 2022 and going forward. So you can see both the IMF and the World Bank really revising their growth forecasts, and it's almost every 2 to 3 months as well that these forecasts are coming down. A lot of our key markets are also expected to slow down, which is not a positive signal from an export point of view. While Sri Lanka, we're going through high inflationary period, one of the highest in our history, if we put it that way. Globally as well, inflation is quite high. The UK as well as the US are seeing inflation at 40-year high levels, close to double-digit levels as well, which is something that is quite unprecedented as well. So some of the trends are very similar between what's going on in the global and local economy, though our local economy is much more, has seen a bigger impact. The other thing what's happening with higher inflation, of course, is central banks, which previously had low interest rates to basically spur the demand and kind of get more economic activity during the COVID period, now reversing gears and looking to increase interest rates. So globally, central banks are doing that, and the US Federal Reserve, which is kind of sets the benchmark rates, because that sets the US Treasury rates, and a lot of things which are borrowed are priced against the US Treasury yield. That was also seen in, I think, around May. We saw a very steep hike in interest rates globally, and that has also been part of the reason why the economy is also expected to slow down. All this means higher prices, consumers having to pay more, the public really not seeing their income growing as fast as costs are growing. So naturally, you're seeing a lot of instability in a lot of countries. We've seen already a few countries who, other than Sri Lanka, who've seen their presidents or their prime ministers changing because of the economic situation and the need to put forward policies that will help the people and livelihoods as well. So that's kind of the global context, just to put that in the back of your mind while we look at the local scenario. So if you look at Sri Lanka, of course, from a growth perspective, the picture is not too great. We're expected to contract significantly in 2022, which is this year, and then slowdown expected to continue in 23, according to the World Bank. And I think the IMF numbers will also get updated quite soon, and that will also point in the negative territory. Central bank governors mentioned that this will be the weakest economic growth or contraction, the biggest contraction we've seen, even larger than what we saw in the pandemic period, where growth contracted 3.7%. So that is largely owing to the slowdown with all the shortages, with the power cuts and so on and so forth, bearing down on economic growth as well. And you're seeing that happening right now in terms of economic activity. We are in the 8th month of the year, but if you look at the Purchasing Managers Index, which is a good indicator to really look at pulse of the economy in terms of manufacturing and services, it's on a downward trend. So anything below 50 means month on month, the sector is not expanding and they're seeing a slowdown. So both manufacturing and services are in that contractionary mode. And once the second quarter GDP number comes out, I think you will see this exemplified much more as well. And I think the worry for Sri Lanka is whether we will get left behind as the region does much better. Of course, right now there's an overall, worry of South Asia as a whole not doing too great because of the debt situations of each country, like Bangladesh showing some concerns, Pakistan showing some concerns as well. And there's a whole narrative around South Asia, external debt crisis taking place, but Sri Lanka, in terms of growth, is not is going to be lagging behind a lot of other countries which are seeing the post-pandemic growth continuing. From our exports and imports point of view, I think the kind of the saving grace has been exports, particular merchandise goods, which is your apparel, your tea, your rubber, your coconut, and so on, continuing to do much better, 14% growth in the first half of this year. While we've seen also imports coming down to a certain extent as well, and that has enabled the trade deficit to come down. We'll get into the specifics of the import side soon, but from a remittances and tourism point of view, clearly we are not doing well. Remittances this year has been down more than 50% compared to the first half of last year. And 50% means a lot because that's $1.7 billion, which are not coming compared to a year ago, or they're coming through other informal channels on financing imports and so on. But that's not coming through the formal banking system, which needs to then finance things like imports and fuel bills and gas bills and so on that the government requires. And of course, we've seen the slowdown in tourism. We did see first quarter of this year doing quite well, and then the second quarter really tailing off as well. Hopefully, the next few months we will see a pickup in these numbers and that contributing towards growth. But if you take a closer look at imports, it's kind of nosedived from 1.8, 1.7 billion a month to now close to 1.2 billion by June. A lot of that has to do with some of the key items coming down on the consumer side as well. There is a contraction on investment goods related to construction and so on. It's slowing down as well, with activity slowing down. But interestingly, the key item in the import bill is the fuel bill. So this is the monthly movement in the last 12 months from June 21 to 22. And you can see how much more, for example, we imported in the first few months of this year, first 4 months. A lot of that has to do with, of course, global oil prices went up, so naturally the value goes up. But also from a demand point of view, also we did see a significant surge in demand because of the uncertainty of firms also importing diesel and so on for generator purposes and so on, and also for electricity generation when the rains haven't been adequate, or renewable energy contribution is not adequate at all. But what you're now seeing is that it's coming down. In particular, if you look at June, it's coming off. And if you look at imports without fuel imports, it's really controllable territory. And I think that'll be the key part of really managing the next few months in terms of managing with our export proceeds to finance our import proceeds, in particular when there is no things like credit lines and to assist us as well. So overall, the volume side of imports are coming down, once again signaling from a growth point of view as well, economic activity point of view. But the value side is slightly high because global commodity prices have been up compared to the previous year. From an inflation point of view, I know this is something that affects us all. The Colombo price index above 60%, food above 90%, and continue to rise. I think with the recent electricity tariff revision as well, we might see inflation rise further. And then maybe after that, with the global slowdown, commodities slowing down, oil is now under $100 a barrel, which it wasn't since February this year. So potentially towards the last quarter and early part of next year, inflation might head downwards and come back to a manageable level as well. But all this means that a lot more are vulnerable. A lot of households are going to be vulnerable in terms of poverty and keeping up with the expenditure and really having the income to manage as well. And I think a study by UNICEF a few months back highlighted that a lot of households are finding it difficult, and they're using coping mechanisms like borrowing money or using their savings to really manage within the current climate. So from a consumer point of view, this might not only impact the low income strata, but even the middle income strata might really get impacted with this crisis. In response to inflation, we've really seen interest rates being increased quite significantly. In April, we saw a 7% hike in policy rates. Earlier in July, also we did see an increase in interest rates, and I think this is really to slow down the economy as well as kind of reduce more credit going towards imports as well. It'll be difficult to see further interest rate hikes to respond to inflation, because a lot of the inflation issues are more supply side related matters. But I think the key thing is, how do we get inflation to ease? And that is, I think the primary factor is confidence building measures, because a lot of people might think, okay, the exchange rate is, or when you price your products and goods, you might be working with a higher exchange rate than what it is actually trading at. So there is lack of confidence of the current trading range as well. That's one example. But overall, confidence that the right steps are being taken and people will be able to get back to some level of normalcy. And the others are really to do with the fiscal side, the external side as well. I mentioned about the commodity prices, which we expect to come down. And I think really not going towards things like price controls and things like that, which hasn't really worked. And once price controls are removed, you've seen even higher price increases as well. Just a few slides on the fiscal aspect. If I quickly get into it, I think we're talking of the IMF program, but key thing is to really see how we as a country are spending. So we've seen expenditure from the government side increasing over the last few years. Particularly 2021, we did see a lot of expenditure because of the pandemic as well, and increases in salaries and wages. If you look at where this expenditure is going, a lot of that is towards salaries and wages of the public sector. A lot of that is towards subsidy schemes and other transfers, but a lot of that component, almost 1 trillion of that, is towards interest payments, which is where Sri Lanka is currently stuck in terms of repaying its external debt as well as its domestic debt. Domestic debt gets rolled over, but paying the external debt really is a key part in this process. And the other component of your fiscal side is your revenue. And you can see we've been on a downward trend since the early 2000s. If you extend this graph to 2000s, it will show you how we've gone from 30% of GDP all the way down, 25% to 30% all the way down to our current levels. And since 2017, it's been nosediving to its current level of single-digit levels, and we are one of the lowest tax to GDP or total revenue to GDP economies in the world. So naturally, you will maintain double-digit fiscal deficits as well. A lot of our tax revenue is a lot of the government revenue is tax revenue. A lot of that is VAT. For example, in 2020, excise duty, income tax, some of the import duties, and then you have the other levies as well. So an IMF program will definitely look at ways to increase this base, either through increases in rates, reduction in exemptions, and simply just widening the base as well. And that will be an additional factor which will have an impact on consumption as well. So just the last few slides, I think, on the currency, we've really seen our reserves, coming to a low level. It's 1.8 billion officially, but if you take away the 1.5 billion swap that we have with China, it's less than 300 million of reserves that we have actively. So that's why we saw the difficulty in June to really import fuel coming in and really building up reserves through either exports or through better control of our imports will be really important in the next few months. And that will be critical in terms of maintaining the current currency. We saw how last year when it was pegged at 200, how it kind of depreciated quite significantly. And now once again, we're seeing it at these current levels. The question is whether it will go more or whether it can stabilize. For that to happen, a lot of things need to take place in that side of it. So the way out, the second portion of what I want to talk about is the stability we need on all fronts: economic, political, social. And for that to take place, at least on the economic side, we need to, of course, secure the IMF loan package. There are two stages in that, the staff level agreement and then the final board level approval. While that's happening, parallelly, we need to be restructuring our debt as well, speaking to bondholders, speaking to our bilateral partners as well. I think only once the staff level agreement comes into play could we look at potential bridge financing options to manage the shortfall that we have in terms of the dollar liquidity. And it's really managing this shortfall each month that will be key now. We're seeing, at least with the queue management system coming in for fuel, at least certain demand is now is reduced, and you're able to price of how many fuel shipments you might need now to cater to the demand within what we can afford as well. So I think that's the kind of confidence building measures, for example, that needs to come in. Technology, better communication coming in to solve real issues as well. And I think the recovery, you could think of it in two ways: reducing the queues and improving availability of goods. Of course, the pricing might come a little bit later, and really going back to a pre-2020 period, which countries which have gone through a sovereign debt crisis takes 5 to 10 years on average to really get through. And that's just highlighting the next slide as well. Some of the recent countries, how some of them have done it. Some of them have negotiated their debt, got an IMF package in short time, like Ecuador, but they went quite early. Or some like Zambia, which are still awaiting board approval from the IMF 2 years later, and are still trying to restructure their debt. So those are the kind of the two extremes in that sense as well. But of course, positivity in the markets could see a certain bounce back. So, for example, the currency in Zambia, though it's depreciated quite a lot because of positive steps being taken, it has kind of recovered at certain points as well. So I'll leave you with a few key messages. I think for the currency, stability really needs to be backed up by confidence building measures, the IMF coming in, the bilateral financing coming in, managing our imports within our export proceeds as well. Interest rates, I think that it's already adjusted a lot to the high increases in policy rates, but it could remain at these levels because the government continues to needs to borrow to meet its expenditure needs as well. But we have to get ready for reforms, I think, whether it's tax reforms, whether it's state-owned enterprise reform, public sector reforms, energy, all of these really need to come into a common framework, which while you have the IMF, you need to be doing a lot of these reforms on our own as well. So I would call it kind of an IMF plus arrangement, where the plus is what we want to get out of the reforms and ensure that we don't come back to this situation once more. Otherwise, we'll be another country like Argentina, which goes through these sovereign debt crises so often in the last few decades. On the inflation side, unfortunately, with the tariff hikes on electricity, inflation could push much higher. That's the key worry in terms of the three stability sides. But I think once global commodity prices ease, we can see maybe certain price reductions coming in, and that then seeing inflation coming down as well. But overall, the next 6 to 12 months from a growth perspective is quite negative, and that's where the reforms also have to be a bit more growth positive as well, friendly as well. So that's in terms of my formal presentation. Dr. Wan, we can take some questions.
Thank you very much, Shiran. I mean, fantastic summary of where we are heading to, and very beautifully captured. A whole heap of questions are coming. My God, I've never had so much of questions in my life. Shiran, the first question that's coming out is that it's coming from Samadhi. She works for a tea company, and she's saying, we had a positive trade surplus in 20 years, I think in the month of June. And the question that is being asked is, if so, why are we short of funding to purchase our basic requirements like the fuels and the gas?
Sure, that's a great question, Samadhi. I think the biggest issue is, even though we are getting 1.1 or 1.2 billion of exports, not all of that exports come in each month. And a lot of that also goes to finance raw material inputs as well. So, for example, I think you're on the tea side, some of your export proceeds might be going to financing your packaging, which might be imported, or the tea bag, and so on and so forth. So not all of it comes in, though it's exported during a particular month. Sometimes there are credit periods as well coming in, and really depends on exporters also repatriating most of their earnings as well. So that I think we don't get 1.2 billion coming in, whereas your import side you have to almost pay most of that each month unless your creditors give you a lot of period. So that's where the shortfall has been, because in the past, what we've been doing is when we've had trade deficits, we've always been using our reserves to pay and ensuring that there's been some way to pay for these expenditure. But now you don't have reserves; you're almost at zero, and that's why I think the central bank has been trying to get the exporters in particular to have greater conversions and limit kind of the outflows as well. But whether it can continue, I think really depends on fuel imports, whether we can maintain trade surpluses, because that has been that's variable on global oil prices and things like that. And hopefully now with the fuel queue system, the demand side can ease, as I said earlier.
Manoj, who's a second-year student from the Staffordshire University MBA, Shiran, is asking a brilliant question. He's saying, we are seeing the fuel queues declining. We see the availability of gas already there. The political unrest has eased out. Why is it that IMF is taking so long in terms of actually moving from a staff level meeting agreement into getting approvals so that we can maybe get the IMF loan within 6 months? As we saw, there are some countries who have got it within 5 months. That is Manoj, Shiran.
Sure. So another, I think, good question, Manoj. So I think when we still haven't got a staff level agreement, and we're expected to get one. In terms of the relative stability you're seeing from the fuel side and the gas side, if I was to explain the gas side, I think that was a procurement of close to $90 million US, of which 70 million came from the World Bank. They repurposed some of their development projects that they were working on. I think they had about 17 projects. Half of those just started last year, so it wasn't too into their projects, and they were able to use that financing and repurpose and provide to the government to meet the government LCs. So that was partly because of this multilateral support that Sri Lanka got on the gas side. On the fuel side, I think we were doing okay till about May because of the India credit line. June, July, of course, there wasn't too much, but now it seems to be getting better. But that is also, I think, for example, for petrol, maybe managing within 2 shipments a month or something like that, which is 75,000 to 80,000 metric tons, 3,000 metric tons a day. And that seems to be the statistics based on the QR code as well. So the technology is kind of maybe disciplining us in a way, and now we're taking more rational decisions, and there's less panic, I think, in the market. So from that point of view, that will continue, and it will almost be a monthly exercise for the central bank to find these dollars from the market going forward, and that might mean sacrificing other types of imports that might be needed for domestic production. Why there's a delay on the staff level agreement, I think, while a lot of people think it's the social and political stability, I think a lot it also to do with the targets that an IMF program will have. Because I just showed you a snapshot of the fiscal side, and the key target will be to get a primary surplus, which is your fiscal deficit, your revenue minus your expenditure minus your interest costs. Right now, we are in negative territory, and we need to get to a positive territory of 2%, I think, by 2025. So what will be the 23 target, 24 target, 25 target? And going to that means almost doubling your tax revenue, or really cutting down on your expenditure. So I think right now maybe the technical discussions are around that, what figure is achievable, and that also links to then your debt restructuring, because based on that, the bondholders and the bilaterals understand, okay, this is what Sri Lanka is doing in terms of getting their fiscal house in order, and this is how much they're willing to compromise to get to a positive level, and then they kind of work out how much they might need to take a loss, because in the end they will also have to take some degree of loss, whether it's delay in the interest payments, the delay in the principal payments, or even cutting down what you get when you're going to get $100, you're now going to get maybe $60 or $70 in the end. So all those factors into that. So I think that's one of the key reasons why it's causing the delay. Of course, the recent stability situation hasn't helped, but I think this technical side is one of the other key reasons that needs to be overcome.
Shiran, there's a question from Vandana, who is a first year MBA student from Staffordshire University again, and she's asking that overall FMCG volume units measurement has degrown by 17.3% on a month-on-month basis by research and agencies are saying, and this is prior to the 75% or 73% increase in electricity. So with the increase in electricity and the increase in water, it looks like the consumer pressure will be stronger on the purse. As at now, World Bank says there are 750,000 households which are on the poverty belt, and some reports emerged saying that by December, there'll be almost 40% of households will be on the poverty belt. How do you see how Sri Lanka's lower end of the spectrum is going to survive in the next 6 months?
Sure. So I think these price changes are things we have delayed for a long time. So if you look at the last time we took a electricity tariff hike, that was 2013. 2015, then the very next year in 2014, just before the elections, we went and took a reduction in the tariff as well. And in these 9 years, costs have of course gone up. We've also not added too much renewable energy, which we should have integrated that as well, because that's more low cost. We've continued to rely on fossil fuel, be it coal or oil as well, and oil fluctuates. So in this current scenario, I think that was a key reason for it. I think we need to get into a tariff system which regularly updates itself, which is kind of de-linked from the political side of it, so that at least the market kind of prices, the correct market price is given as well. I think for the lower strata, I think they're looking at some sort of a cash transfer or a reduction from the total increase as well, so that they're not impacted as much. Water, as you said, is another area which is significantly subsidized from cost of generation. I don't think they will look at that at the moment. It's mainly the fuel and electricity in the lead up to an IMF program that will be looked at. But overall, this is not good for consumption, FMCG. You will see, I think, shrinkages in volume and the basket, and maybe substitution to other kind of other products as well. And this might play out in the next 3 to 6 months as consumers kind of adjust as well.
There's Ajay, who's actually based in UAE, and he's asking, have we really started any reforms that IMF is looking for? Or is it that the price increases on electricity and water was only just the start of a reform program?
Yeah, so I think, as I just mentioned, the electricity and fuel, if you do move into more transparent pricing formula, I think that will be a key part of it, because if you look at the 2016 IMF program as well, fuel pricing formula was a key aspect of it. On the electricity side as well, having a kind of an open, rational system to do it was a key part of it. The electricity, I think there's a lot more to do, because on the generation side, there is significant ways we can be more efficient in terms of what we're using, the source. Things like renewable energy integration needs to take place now at a faster pace to meet up with the demand. So there are those reforms within the sector that need to take place, and I think that it looks like they're taking steps on that side of it. The other key piece of reform is state-owned enterprise reform, because if you look at SOEs, I think it's 3 to 5 institutions that make up about 95% of the losses. So if you look at even Sri Lankan Airlines or Ceylon Petroleum and so on, I think there will be, I think it will get captured in this IMF program as well, but there will be things that we need to do both on the governance side, on the marketability side, on the pricing side as well, which needs to come in, and of course reduce with a focus on reducing the losses. So those reforms will be key. I think those ones will be the top priorities in this IMF program, because all of that in the end gets linked to our fiscal picture, which is the key target that the government will be looking at.
Interesting question coming up, Shiran. What was the logic of the $500 million sovereign bond payment in January, when currently we have less than $20 million in the coffers? What is the logic of that decision? And do you think that there could have been a greater influence of the monetary board in the decision making? It's coming from Kisal, who works with Daras, is on the MBA program year 1.
Right. Yeah, so I think there was a lot of since 2020, and the pandemic broke out, Chamber and so many others, want the government to go to the IMF, seek some level of assistance at that point. Find out what you're seeing, what Bangladesh have done when they lost a little bit of reserves, and there's a slight downturn. They've quickly looked at the different measures and acted upon it. Unfortunately, we didn't. I think our strategy was more homegrown strategy, which really relied on exports doing exponentially well, FDI coming in, things like Port City really coming in a big way. And I think our expectation was that India or China will, continue to bail us out, which did not materialize. We could have avoided, paying. We could have, similar to what Ecuador did before the pandemic. They went out to the market and said, "Hey, we can't afford to pay this. We need to take a pause, and we will come back to you with a plan." And that's how they kind of restructured their debt within 5 months, and now they've come back into the market as well. But we lost that opportunity very early on by delaying going to the IMF and pausing our debt, and eventually we only stopped paying the debt in April when reserves were at what it is right now. So that 500 million, unfortunately, could have been kept back, could have been used in hindsight for payment of essential imports, and in the end, the people have felt the pinch of that decision as well. So I think it's a lot to do with it's not only the monetary board. I think it's the Ministry of Finance, all of those who are in those positions that need to kind of relook at those decisions.
Thank you, Shiran. And I've just taken the last question because I told it's only a 45-minute discussion. And the question is, um, I work in the SME sector, and I find that our premiums on our loans have increased. We have a challenge with regard to reduction of the demand cycle, and now we see the whole market shrinking. We thought we had seen the worst, but then the electricity hike that's going to have an impact is going to have a greater spiral effect on the company's costs. How can an SME survive in this context? And what do you think should be how we should look at the economic outlook in the next 6 months?
Thanks. So I think you're referring to the interest rates. So as I mentioned in the slides, we did see a very sharp increase in interest rates really to slow down the economy, reduce the borrowing as well. I think what should not happen is interest rates increasing further to match with what the inflation is at, because I think that might not really assist. But I think gradually over time, maybe the interest rates can come down once the economy stabilizes, maybe the next few months or in the early part of next year. And that might help businesses and SMEs in terms of refinancing and kind of working capital. For an SME to survive, I think similar to the COVID period, which is more of a demand shock, I think it's also trying to find ways, to stay lean, to not really take on debt at this point, because I think now would be the worst time to borrow, given these high rates, and even to borrow long, and really look to innovate. I think it's easy to say, but difficult to do. But I think there are opportunities, maybe at a regional level or at a community level, to get a few products out there to test the market, and people might be more receptive now compared to the previous times. Like a few months ago, no one would have wanted to really buy a bicycle, but now we're buying a bicycle because it's much more better than staying in queues and getting around it. So there are those opportunities which I think SMEs can really latch on to and try to grow their businesses, and then once you have a credible business model, search for potential investors, and there are quite a lot of those available to kind of invest and scale your business. So that would be my advice.
Thank you very much, Shiran. It was a lovely, very focused session. Fantastic response coming in from the students also in terms of the questions that the MBA graduates had. Can I, Ruth, over to you, please?
Hi, good evening, Mr. Shiran. I must say thank you so much for you being with us on this platform, for sharing your knowledge and your insights with us and with our students. So as always, as we come to a close of yet another webinar series, I'd like to remind our audience and our industry partners that here at APID, we have an extensive internship program. So if you do have any opportunities available or opening up soon at your organization, do feel free to contact us. With that said, as we draw to a close at this webinar session, I would like to thank our IT team at APID for the technical support, our students, our alumni, our industry partners and well-wishers across the world and here in Sri Lanka for joining in, asking your questions and clearing out your doubts. So with that said, I'd like to wish everybody a good day, a good afternoon, and a lovely evening from wherever you are tuning in with us. Till we meet again at yet another session, take care.